Hi there, welcome to Nebby Invest. One of my favorite buy signals, if not the favorite buy signal I have, is when a company's share price breaks out on positive financial news. And typically that positive financial news is a profit or earnings upgrade. Could be just a simple trading update where the company is doing better than expected, or it could be when a company releases their financial results and their financial results beats the market expectations. Now, historically, when these sort of announcements are released by a company, the share price of that company will rise. That is the expectation that I have and the market has, that these sort of positive news events will lead to an increase in the company's share price. But over the past few weeks, I've noticed a few interesting things on the Australian and American markets where this sort of buy signal has become less reliable. For example, a company called Satire, ticker code is CTT, released positive news or positive announcement to the market the other day. Satire IPO'd on the Australian market in December 2020 at around 50 or 60 cents, and the share price has tripled since then. Now, when a company does IPO, they do have some guidance or forecast of their financial results in the prospectus. And sometimes a company will release an upgrade or a downgrade to their prospectus guidance. We've seen that with Nuix, where they've actually downgraded their expectations, and we've seen the share price really pull back from about $12 to $4 or $5 because downgrades are one of the worst things a company can do, particularly if they've just IPO'd. But Satire did the complete opposite. They upgraded the expectations. And when a company upgrades their expectations, particularly a new company who has just recently IPO'd, that usually and historically is good news for the share price because the share price should increase because it's an upgrade. But Satire's share price has actually done the complete opposite. It has actually gone from $1.77 to a current share price of $1.46. So that's almost a 20% decrease in the share price over a few trading days. So obviously, even though Satire upgraded their profit guidance, it did not beat the market expectations. The market was actually expecting more from Satire. They expected them to beat their expectations by a greater amount. So it actually disappointed the market. Something else I'm seeing in America right now as companies are releasing their quarterly results and the results are beating market expectations, we're still seeing the share price of these companies actually decrease, which is against the expectations historically of what we should be seeing, because when a company beats the expectations of in their results, the share price should go up. So what is happening here? I'm thinking, and this is just my thoughts on this, I could be completely wrong, that the expectations we're talking about, or what we usually say, is in regards to what the experts or those analysts who are covering the company, what are their expectations? And I believe the expert expectations are lower than the retail expectations. And because retail investors right now have a lot more power, when they have higher expectations than the experts and the company results actually don't beat the retail expectations, you will see the share price decrease. And that is what we're seeing now, because I just think at this point in time, retail investors' expectations for the economy, for individual companies, is probably a little bit too high now, a little bit too frothy. So in this video, what I'm going to do is look at 4 companies who release positive news to the market, profit upgrades, that sort of thing, and we'll just see if the share price is breaking out and whether these companies are a potential buy for the medium to long term. The 4 companies I'll be covering or featuring in this video are Steadfast, McGrath, Mirvac, and Bluescope still. For full disclosure purposes, I have been a shareholder of Bluescope and I recently sold out to take profits. A lot of tailwinds behind that company, and those tailwinds are still going on. So that could have been a little bit of a premature sale on my part. But in my opinion, Bluescope still is definitely not a buy and hold company. You want to buy that company when they have tailwinds behind them and sell them when they've got headwinds. I think that's probably true for most companies, in particular Mirvac and McGrath in this list. I think Steadfast, you could argue that is a buy and hold sort of company, particularly when you look at their financial results over the past 6 years or so, and definitely when you look at their long-term chart. Speaking of Steadfast and their long-term chart, this is it. So first company I'll be featuring in this video is Steadfast. This is an insurance broking company. In fact, there's a couple of these sort of companies on the ASX. Oswide, I think, is the other one, and they're both doing fairly well. So Steadfast has a market cap of 3.7 billion and really good revenue and operational cash flow. But in isolation, that means nothing. It will be good to see what the growth rate of those two are, and actually we'll have a look at that in the next slide. But when you look at their 8-year monthly chart here, this is the sort of chart you want to see if you're a buy and hold investor, because the share price is going from the bottom left to the top right, which means the share price is in an upwards trend through the last 8 years. So really good buy and hold sort of company. And we'll just look or see the difference or compare the difference between Steadfast and the other companies when we look at their long-term charts. So when I look at this, and I've included the 10-month, 20-month, and 50-month moving average, the best time to buy Steadfast with the lower risk, higher reward sort of time is whenever the share price just gets below the 20-month moving average. So it's happened 3 times, excluding the COVID-19 financial panic. So these are the 3 times it's happened, and these are the ideal times to buy in Steadfast. So you can be patient and wait for this to happen, and that's when you make a purchase. So it happened in early 2018, early 2019, and towards the later period of 2020. So it does happen quite often, maybe every 1 or 2 years. And right now, it's at the all-time high share price and is still increasing. So a lot of tailwinds behind this company. The share price, the chart looks great, and the financial state of the company also looks great. And the only thing we really have to look at is whether the company is growing. Now on to the 6-month daily chart for Steadfast. But before I talk about that, I've also included the growth rates of revenue, operational cash flow, and share price over the past 5 years for Steadfast. And very impressive numbers here. And in fact, when you look at revenue, 16%, operational cash flow, 28%, and share price increases at 19% per year. This is the ideal buy and hold sort of company. So if I was that sort of investor, the buy and hold, this would definitely be the type of company I would be looking to buy and then just hold for as long as possible. Now, ideally, when I compare revenue and share price, revenue and operational cash flow growth to share price growth, I want those to be similar, because if you see share price growing at a significantly larger rate than revenue and operational cash flow, that is telling me the market is willing to pay a bit of a premium for the company at that point in time. And the premium market is willing to pay does wane, it does go up and down. And the ideal to buy a company like Steadfast is when the market is willing to pay less of a premium for the company. And you can see this all the time with these sort of growth companies. For example, Apple in 2016, the PE ratio for Apple was about 12. So the premium the market was willing to pay for Apple in 2016 was at its lowest point. And since then, with the PE ratio going from 12 to something like 30, 35, that is telling me and telling us that the premium the market is willing to pay has increased. And that is what is called multiple expansion. When you see the share price increasing because of multiple expansion, not financial expansion, that is just telling us that the market is willing to pay more of a premium for that company. Now back to the chart, the 6-month daily chart for Steadfast. And to be honest with you, if I was a buy and hold investor, I'd be more focused on the weekly or monthly chart instead of the daily chart, because the daily chart has a lot of noise in it and you want to cancel out that noise or just screen it out. Maybe this is a buy the dip strategy, or you can employ the buy the dip strategy with Steadfast. You can see a bit of a dip in the share price in March and April. The share price got to about $3.80. So Steadfast released an announcement to the market on the 28th of April, and they upgraded financial year 21 guidance. So a lot of times when a company releases that sort of news or announcement to the market, you will see the share price increase, but the share price really hasn't increased substantially. So in my opinion, this is just my opinion, the market was expecting Steadfast to upgrade their financial year guidance. So they have upgraded, and here is the upgraded or the revised guidance. So EBITDA has increased from, say, we'll talk about the high point. So 255 to 266. Net profit after tax increased that from 127 to 132, and diluted EPS growth from 10 to 15% to 15 to 20%. So definitely good news for the financial state of the company. But again, I think the market expected Steadfast to increase their guidance. Second company I want to talk about is McGrath. This is a real estate agent type of company. They did a little bit more than that, but market cap of 113 million. And when you look at their revenue and operational cash flow in the trailing 12 months, particularly the operational cash flow, 24.4 million, suggests there is a bit of value here, even though the share price has tripled over the past 8 months or so. So before the share price tripled, we can see the share price of McGrath in a really long-term downtrend from 2016 to the middle of 2020. It did seem like the sentiment tried to shift in late 2019, but then the COVID-19 financial panic hit in February, March of 2020, and the share price retreated back to 20 cents. But there definitely was a shift in sentiment towards the later period of 2020 right there. And we know there was a sentiment shift just by looking at the moving averages. Whenever you see the share price below the 50-week moving averages, so that grey line there is the 50-week. So whenever the share price is below that, there is some negative sentiment in the market. It tried to turn, as I mentioned, in late 2019, but failed. And you can see the share price, as the sentiment shifted from negative to positive, the share price then went above not only the 50-week moving averages, but the other two moving averages. And that is the very definition of a shift in sentiment and a positive shift and positive momentum behind the share price. So in the next chart, we'll see the shorter term, the daily chart, and I'll show you what caused that shift in sentiment. Typically, there has to be some sort of catalyst, and I'll talk about that in the next slide. When you look at the one-year daily chart from McGrath, this is a beautiful looking bit of art right here, because the share price is going from the bottom left to the top right. In fact, the share price has tripled in that period of time. Now you can see if you go back to June, July, August last year, the share price was going sideways at just under 20 cents. So what was needed at that point in time for the share price to go higher was a catalyst. So there was no point buying into McGrath during June, July. Share price was going sideways. You don't know what the next catalyst to drive the share price higher or lower was going to be. So there could have been some negative news that could have set the share price down to 20 cents. So all you had to do was just be patient and wait for that catalyst. And we received that catalyst in August of 2020. And you can see that catalyst just by looking at the chart. The share price increased, and coinciding with the share price increase, a massive spike in volume. So without even knowing, we know there was a positive announcement released by McGrath on that day. And this was the positive announcement. So it was a 10 million EBITDA turnaround. So they went from a loss of 6.4 million to a profit of 3.7 million. And you can see the share price action just after that for the next 2 months. It went sideways between about 25 and 28 cents. So you had plenty of time to hop on board the McGrath turnaround story. And then from November to current times, the share price has gone from just shy of 30 cents to 66 cents. So still a double in the share price of McGrath. And just the other day, they released another positive announcement, and this was a profit guidance and trading update. So they now expect EBITDA to be in a range of 16.5 to 17.5 million, which is a significant increase on the previous year of 3.7 million. So this is the reason why the share price of McGrath has tripled in price over the past 8 months. These positive news from the company. The third company I want to talk about is Mirvac. This is a property group and not the sort of company I would ever think about buying unless I had some sort of positive news from the company, and we may have received that the other day. So just by looking at their 22-year monthly chart, you can see why this is not the buy and hold company, because if you bought Mirvac in 2007 at around $5, the share price has still not got back to your buy-in price. In fact, the share price fell from $5 all the way to a low of about $1 in 2009 and has only gone from $1 to a current price of $2.68 in 12 years. So not a real good growth rate in the share price. But the share price in the 22-year monthly chart does show a bit of an uptrend there. There's that uptrend, and maybe if you can buy in when the share price gets to that uptrend, maybe you can make a little bit of money with capital appreciation in Mirvac, but I'll be very wary of buying this company. Market cap 10.6 billion, revenue 1.8 billion, and operational cash flow 551 million. So even looking at the operational cash flow and comparing that to the market cap, still a bit on the high side. I'd probably prefer to see either the market cap down or a higher operational cash flow. Now, something interesting when I look at this chart is the similarities of what happened just before the share price decreased during the GFC and what happened with the share price just before we saw the COVID-19 financial panic. You can see the run up in the share price, then the share price went sideways, and then a massive collapse in the share price. I think the only difference between the GFC and the COVID-19 financial panic was the response of the economies during both or after both events. We saw a much slower response in the economy after the GFC, which is natural enough, and that's why the Mirvac share price kept on dropping. And then we've seen a much better response after the COVID-19 financial panic. And it's just really funny that we did see a very similar pattern during both periods of time. And so maybe in the future, if we see Mirvac's share price go on a bit of a run, go sideways, that could be a harbinger of another correction in the market, just as something to ponder for now. When I look at the 1-year day chart for Mirvac, nothing at all exciting when you look at this. It's just going up and down, sort of a wave-like pattern. And when I see these sort of wave-like patterns, I don't get excited at all. The only thing is they did upgrade their guidance just the other day. So announcement, third quarter 21 operational update and earnings upgrade. Those are two magic words. Whenever I see an announcement released from a company and it has those two words, earnings upgrade next to each other, I always pay attention. So this was the important part of that announcement. They have increased the financial year 21 earnings per security from a range of 13.1 to 13.5 to 13.7. And the CEO and Managing Director, Susan Lloyd-Hurwitz, was quite bullish about the business and how it was performing, and there was strong momentum leading into the final quarter of the business. So maybe there is potential that those tailwinds behind the business will drive the share price upwards from here. But at this point in time, because we can be a little bit picky about what companies we buy into, I think at this stage I will steer clear of Mirvac. The final company I want to talk about today is Bluescope Steel. This company has a special place in my heart because it was the first company I bought when I started to test out my momentum sentiment strategy. And it definitely worked in the case of Bluescope Steel because the share price increased 55% from when I bought to when I sold, potentially a little bit earlier than I should have because I sold and just because the share price had reached a 13-year high. And I didn't think the share price would increase much more from that, but it has. It's gone up another $2 or $3. Now, not really the buy and hold sort of company. And you can just see that with the chart here. If you bought in 2007 or early 2008 at $50, you've seen your value of your holdings halve. And even though the share price has gone on a bit of a bull run lately, it's still not got back to half the share price you would have bought in at $50. So current share price, $22. But interestingly enough, even though the share price is only $22 compared to $50 back then, the valuation of Bluescope is actually higher now because the amount of shares on issue have doubled or more than doubled. So The market cap of Bluescope Steel, I think, is at an all-time high, even though the share price is significantly lower than it was back in 2007. There are a lot of tailwinds behind Bluescope Steel at the moment, and we can see those sort of tailwinds just by looking at the one-year daily chart. The share price has increased from $10 back in May of 2020 to a current share price of $22. So not only do we know there's a lot of tailwinds behind this company, so they're a steel maker and steel prices are going up, we also can confirm the tailwinds by the fact that Bluescope Steel have released 4 earnings upgrades since October. So they've released one in October, another one in November, one in February, and then the most recent one in April. Real interesting share price action in the most recent earnings upgrade, when the share price opened at $24, so up 10%. There was a lot of selling that came into the market and pushed the share price of Bluescope from $24 to $22. A few reasons I could think of why that happened. I think there was profit taking, so there would have been a lot of investors and fund managers out there just like me who saw the share price at a 13-year high and the valuation of the company at an all-time high and just thought they would lock in profits. Also, it could be argued the market was expecting this earnings upgrade, and it could have been just sell on the news, buy the rumor, sell on the news, which is why maybe the share price had gone on a good run from $18 to $22 over the past few months. But in saying all that, it was a very impressive earnings upgrade. So they've increased guidance for EBIT from a range of 750 to 830 million, and they've increased that to a range of 1 billion to 1.1 billion. That's a 33% increase in EBIT or guidance. That's very impressive. And the fact they've had 4 earnings upgrades means there is potential of more in the future, because we don't know how long this earnings upgrade cycle will continue for. It can continue for the next few years simply because steel prices are still going up. That is all for this video, but I do have at least one more video in this series planned. And in that video, I'll be featuring 4 companies who released a positive financial news to the market: 5G Networks, Satire, Nick Scali, and National Tire Wheels. But in that video, I'll be discussing why the market reaction to some of these announcements from these companies was negative, not positive. So I hope you join me for that video, which I should be doing in the next week or so. Otherwise, that's all for this video. If you want to leave a comment about any of these companies I talked about in this video, or any of the companies I'll be talking about in the next video, make sure you leave it in the comment section, and I will answer any comments I receive. Otherwise, I'm not a financial advisor, so if you do need to seek financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's all for this video. Have a good day. See you later.